Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is October 21st, 2024, and we're diving into the third quarter earnings report of Zions Bancorporation. Joining us is John, our senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. It's a pleasure to discuss Zions Bancorporation's latest financial results.
Let's get started. Zions Bancorporation has just released their third quarter 2024 financial results. Can you give us a brief overview of the company and the highlights from this report?
Absolutely. Zions Bancorporation is a leading financial services company operating in 11 western states. For the third quarter of 2024, they reported net earnings of $204 million with a diluted EPS of $1.37. This is a significant improvement from the same quarter last year, where net earnings were $168 million and EPS was $1.13.
Revenue and profitability overview. Let's start with the top line. Zions Bancorporation reported a net interest income of $620 million, up 6% from last year. John, what are the key drivers behind this growth?
The increase in net interest income is primarily due to higher earning asset yields, which were partially offset by higher funding costs. The net interest margin also improved to 3.03% from 2.93% a year ago, reflecting a favorable mix change to higher yielding assets and an increase in interest rates.
That's impressive. How does this translate into their overall profitability?
Well, the net earnings for the quarter were $204 million, with an EPS of 1.37 cents, marking a 21% increase in earnings per share compared to the same period last year. This indicates strong profitability driven by effective cost management and revenue growth.
Operational efficiencies and future outlook. Moving on to operational efficiencies, Zions reported a non-interest expense of $502 million, up just 1% from last year. How does this impact their efficiency ratio?
The efficiency ratio improved to 62.5% from 64.4% last year, indicating better cost management relative to revenue. This is a positive sign as it shows the company is effectively controlling its expenses while growing its revenue base.
And what about their capital position and future outlook?
Zions has a strong capital position with a CET1 ratio of 10.7%, up from 10.2% last year. They also reported a 3% growth in loans and leases, which is a good indicator of future revenue potential. The company is well positioned to continue its growth trajectory, supported by a stable economic environment and strategic initiatives.
Credit quality and risk management. Let's discuss credit quality. Zions reported a provision for credit losses of $13 million, down from $41 million last year. What does this tell us about their risk management?
The lower provision for credit losses indicates improved credit quality and effective risk management. Despite an increase in classified loans to $2.1 billion, the net charge-offs were just $3 million, reflecting strong underwriting standards and borrower support.
How do non-performing assets factor into this?
Non-performing assets increased to $368 million, or 0.62% of total loans and leases. While this is higher than last year, it remains manageable, and the company expects credit losses to remain well controlled due to strong equity and sponsorship in their loan deals.
Strategic initiatives and market position. Finally, let's talk about Zion's strategic initiatives. They announced an agreement to acquire 4 branches in California's Coachella Valley. How does this fit into their market strategy?
This acquisition is a strategic move to strengthen their competitive position in the California market. It adds approximately $730 million in deposits and $420 million in loans, enhancing their market presence and customer base in a key growth area.
And how does their deposit growth support this strategy?
Deposits grew to $75.7 billion, with a loan-to-deposit ratio of 78%. This solid deposit base provides a stable funding source for their lending activities and supports their expansion plans. The focus on market expansion and customer acquisition is likely to drive future growth.
Key takeaways. In summary, Zions Bancorporation has delivered a strong performance in the third quarter of 2024, with significant improvements in profitability and operational efficiency. Their strategic initiatives and solid capital position bode well for future growth. John, any final thoughts?
Zions is well positioned for continued success, with a strong focus on cost management, strategic market expansion, and maintaining robust credit quality. Investors should keep an eye on their growth trajectory and market developments.
Thank you, John, for your insights, and thank you to our viewers for tuning in. If you found this analysis helpful, please like, share, and subscribe to Smart Stock Watch. We'd love to hear your thoughts on Zions Bancorporation's performance in the comments below.